like, share, and subscribe. Wishing you happiness and good luck every day.
Warren Buffett. You hear that name and you immediately think investing genius, right? He's the Oracle of Omaha, the man who turned a little textile mill into a global empire. And man, there are a million books out there about him, but so many of them miss the most important thing. So today, we're going to deconstruct that legend to find the real practical wisdom that you can actually use.
And that, right there, is the heart of the problem, isn't it? As Vahan Janjian points out, it's one thing to stand back and admire the guy, but it's a whole other ballgame to figure out which parts of his playbook we can actually copy. And that's exactly the gap we're going to close today. We are separating the man from the myth to find the method.
So here's our game plan. First, we'll talk about the Buffett we all think we know. Then, we're going to bust two of the biggest myths about how he invests: his supposed hatred for diversification and his reputation as just a simple bargain hunter. We'll swap each myth with the reality, and then, at the end, we'll boil it all down into a playbook that you can actually take with you.
All right, first things first, let's just acknowledge why he's such a giant in the first place. I mean, Buffett's track record is just staggering. We're talking about a guy who turned one investment in the Washington Post Company into an 11,600% gain. He's famous for saying his favorite holding period is forever. This is the legend, right? The larger-than-life figure we all know. But you know, like with any legend, the popular version of the story, well, it's just not the full story. The real way Buffett invests is so much more complex, full of what look like contradictions. And digging into those complexities, that's where the really useful stuff is.
Okay, let's jump right in and tackle our first big myth. This idea that Warren Buffett is the sworn enemy of diversification. You've heard the advice a million times, don't put all your eggs in one basket. Well, the legend says Buffett takes that advice and just tosses it right out the window.
And look, this is where that myth really gets its power. This is from his 1993 letter to shareholders. Buffett himself wrote this, dismissing what he calls standard diversification dogma. Seems pretty open and shut, doesn't it? He believes in making huge, focused bets on just a few companies he really understands. But is that really the whole story?
Okay, so let's pivot to what's really going on, because this is where things get truly fascinating. It turns out there are kind of two versions of Warren Buffett's advice when it comes to diversification. There's one set of rules for him and another set for pretty much everyone else.
And here it is, the big paradox. For the true expert, I mean someone who can really dig in and analyze a business at his level, Buffett says, yeah, 6 companies might be all you need. But then he says for everyone else, the other 99% of us, his advice is the complete opposite. Diversify, maybe with a low-cost index fund. So you see, he's not against diversification. He's against blind diversification for people who have the skills to do the deep dive work.
And get this, Berkshire Hathaway itself is the perfect example of this paradox in action. I mean, just look at the numbers. It owns over 70 separate companies outright. It has big stakes in more than 40 other public companies. It holds tens of billions in cash and bonds. On the surface, that looks super diversified. But then you look closer, and bam, more than half of its entire stock portfolio is piled into just 4 massive holdings. It's this giant diversified company built on a handful of incredibly concentrated bets.
All right, let's move on to myth number 2. This is a big one. It's the story of Buffett as the ultimate bargain shopper. You know, rummaging through the stock market's discount bin, just looking for anything that's statistically cheap.
Yeah, the story you usually hear is that he just hunts for stocks with low price-to-earnings ratios or low price-to-book ratios, these quick and dirty metrics for whether a stock is cheap. And it's a nice, simple story. Find a stock that looks cheap on paper, buy it, and just wait. But that just barely scratches the surface of his genius.
So let's really put this idea to the test. On one side, you have the Washington Post, a classic Berkshire investment. On the other, you've got Google, a company Berkshire has never touched. Now, if you're just looking at a simple metric like the PE ratio, the Post looks like a decent deal. Google, on the other hand, looks wildly expensive. But, and this is a big but, Buffett's analysis goes way deeper than these surface numbers.
And that right there brings us to the reality of how Buffett actually figures out what a company is worth. He's not looking for what's cheap today. Nope. He is looking for something much bigger, a company's true, underlying, intrinsic value.
And that's the secret weapon.
Intrinsic value. The easiest way to think about it is this. We all know a dollar you're promised 10 years from now is worth less than a dollar in your hand today, right? Well, intrinsic value is just the process of figuring out all the cash a business is going to produce over its entire lifetime, and then calculating what that huge pile of future money is worth today. It's about finding the real, honest-to-goodness worth of the business, totally separate from its bouncing stock price.
The fancy name for the tool he uses is discounted cash flow, or DCF. It sounds complicated, I know, but the idea is actually pretty simple. Step 1 is to project. You put on your business analyst hat and you try to estimate all the cash that company's going to kick out in the future. Step 2 is to discount. That's where you account for the fact that future money is worth less than today's money. When you're done, you get a single number, your estimate of that company's true value. And finally, step 3 is to compare. This is the moment of truth. You take your number and you look at the stock price, and you only buy if the market is offering you that business for way less than what you think it's actually worth.
This sentence, it just perfectly captures the entire philosophy. Let that sink in for a second. He doesn't want cheap stocks. Companies that are cheap for a reason because their business is terrible. He wants to buy wonderful businesses at a cheap price. Big difference.
So at the end of the day, it's not about the PE ratio. Not at all. It's all about one thing. How big is the gap between the price you have to pay and the value you actually get? A fantastic company with amazing growth, like Google in our example, could be a buy for him, but only if its stock price fell so far that it was a true bargain compared to its intrinsic value. The PE ratio, it's mostly just noise.
Okay, so now that we've busted these huge myths, the big question is, how do we actually invest more like the real Buffett? What are the principles we can take away from all this and actually apply ourselves?
So what's the takeaway for us? Well, it's all about focusing on solid principles, not trying to predict the future. And what's really interesting is that a lot of academic research, like this famous study, actually backs up what Buffett's been doing for decades. It shows that if you stick to a disciplined approach, like buying smaller companies or statistically cheaper companies, it has historically led to better returns. It just reinforces Buffett's main idea. Having a real, business-focused strategy is what wins, not chasing the hot new thing.
And this all leads back to one of Buffett's most critical pieces of advice, but one that people often forget. Study after study has shown that over 90% of your long-term returns don't come from picking the right stock. They come from your asset allocation, your big picture plan. That's why for most people, his advice isn't some hot stock tip. It's to buy a simple, low-cost, diversified index fund. He knows that getting the overall strategy right is way more important than trying to find a needle in a haystack.
So let's put it all together. Here it is, the real Buffett playbook. These are the principles that never go out of style. Think like you're buying the whole business, not just a little ticker symbol. Do the work to really understand where its cash comes from. Always know the difference between price and value. Your favorite holding period? Yeah, it should be forever. I love that one. Remember that patience is your superpower, and maybe most important of all, only invest in what you can actually understand.
Buffett has said it himself, time and time again. By far, the best investment you can make is in yourself. He spent his early days just devouring every single book he could find on investing and business. So the real lesson from the Buffett paradox isn't some secret formula or a hot stock tip. It's a commitment to always keep learning. So the real question is, after this, what's your next investment in yourself going to be?
When you hear the name Warren Buffett, you pretty much immediately think investing genius. But on one of the most basic, fundamental rules of investing, diversification, the man is a walking, talking puzzle. So today, we're going to jump right in and deconstruct what has to be one of the biggest paradoxes in the entire world of finance. So let's just get right down to it, right? What's the deal? Where does he really stand on this? Is he for it or is he against it? Because man, if you look at what he's said over the years, you're going to find some quotes that seem to completely contradict each other. I mean, just look at this. Back in '93, he calls diversification dogma, basically something you follow blindly. But then, just 5 years later, he's saying that 99%, almost everybody, should do it. It sounds like the classic, do as I say, not as I do, right? Well, maybe it's something a little deeper than that. And that's the paradox we're here to solve. All right, so here's how we're going to break this all down. First, we'll tackle the paradox itself. Then we'll cover the textbook rules that Buffett seems to just ignore. After that, we'll dig into why experts like him actually choose to concentrate their bets. Then comes the plot twist. What's going on with Berkshire Hathaway itself? And finally, we'll put it all together and figure out what Buffett's advice is for you. We'll wrap it all up with a really powerful idea, the difference between building your wealth and protecting it. You know, to really get why Buffett's approach feels so radical, we first have to understand the conventional wisdom. This is the stuff that's taught in every single MBA program and Finance 101 course on the planet. It's the bedrock of what they call modern portfolio theory. And the core idea is actually really simple. It's the old saying, don't put all your eggs in one basket. Makes sense, right? You spread your money around so that if one of your investments tanks, it doesn't take your whole nest egg down with it. The number one goal here is just to lower your risk. And it goes even a step further than that. It's not just about owning, say, a bunch of different stocks. It's about owning different kinds of investments. We're talking stocks, bonds, maybe some real estate, cash, because all of these things tend to act differently depending on what the economy is doing. So the big promise here, the whole sales pitch of this theory, is that if you diversify the right way, you can get the best possible return for whatever level of risk you're comfortable with. It's sold as the mathematically perfect, optimal way to invest. But this is where Buffett starts to have a big problem, and it starts with the very definition of the word risk. And this, right here, this gets to the absolute heart of the disagreement. Textbook finance says risk is volatility. So if a stock's price swings around a lot, even if it's swinging up, they call it risky. Now, to Buffett, that's just nuts. Why would you ever be afraid of a stock price going up too much? For him, risk is way simpler. It's the chance of losing your money permanently. The real possibility of injury to your capital. That's it. So, once you get that Buffett sees risk in a totally different way, his whole counter-argument starts to click into place. For him and his brilliant partner Charlie Munger, if you're a real expert, concentration isn't just okay, it's the only thing that makes any sense. And believe me, they do not mince words about this. Charlie Munger's take on all that academic theory is famously, well, blunt. He called it a type of dementia I can't even classify. So yeah, this isn't some polite disagreement. It's a complete and total rejection of what the academics are preaching. So if owning hundreds of stocks is a bad idea, how many do you actually need? Well, for someone who truly, deeply understands how to value a business, Buffett thinks this is the magic number. Just 6. He says if you really know what you're doing, owning 6 wonderful companies is all the diversification you will ever need. And hey, you don't have to take his word for it. Just look at the real-world evidence. When you look at how the richest people on the planet actually built their fortunes, you don't see a list of people who just bought a bunch of index funds. No way. You see founders, you see visionaries who poured everything they had into one single great idea. Gates, Allison, the Google guys, Michael Dell, every single one of them got there through intense, focused concentration. So here's the thinking behind it. Buffett believes that when you spread your money across 50 or 100 different stocks, he calls it diversification. You're basically admitting you don't know much about any of them. For him, real risk reduction comes from knowledge, knowing just a few businesses inside and out better than anyone else. That deep understanding is a way better defense against losing money than just owning a little bit of everything. Okay, so you're probably thinking, got it, experts concentrate. Buffett's an expert. Case closed. But, and this is a big but, here comes the plot twist. If you take a peek under the hood of his own company, Berkshire Hathaway, today, well, it looks an awful lot like it's diversified. And if we pull up the numbers, you'll see exactly what I mean. Now, this is from a few years back, but it makes the point. Berkshire's stock portfolio is loaded with dozens of household names: Coke, Amex, Wells Fargo, and that's on top of the dozens and dozens of private companies it owns completely. This does not look like a portfolio with just 6 companies in it. But hold on, if we dig just a little bit deeper, we find the catch. Even inside that portfolio that looks so spread out, the old Buffett DNA is still there. Back in 2006, over half, 54% of the entire stock portfolio was sunk into just 4 companies. So while they owned a lot of different things, their real conviction and their big money was still piled into their absolute best ideas. So what gives? Why did they change it all? Well, it's a good problem to have, really. It's a problem of success. Berkshire Hathaway has just gotten so enormous, so massive, that it's physically impossible for them to stick to that old strategy. When you have billions and billions of dollars you need to invest every quarter, you can't just dump it all into 6 small companies. You'd end up owning the whole thing. They are forced to diversify simply because of their own incredible size. Okay, so this is where we finally get to tie all these different threads together and solve this puzzle once and for all. We've seen the contradictions, the theory, the counter-argument. So what does all this mean for the average person, for you, trying to do the right thing with your money? And there it is. The whole paradox solved on one slide. It's not one piece of advice. It's two completely different playbooks for two completely different types of players. If you are an expert, and by that, he means someone willing to make analyzing businesses your life's work, then you should concentrate. For pretty much everybody else, the other 99% of us, his advice is the exact opposite. Diversify, and do it in the simplest, cheapest way possible. And this isn't me interpreting his words. This is straight from the horse's mouth. This quote from one of his shareholder letters says it all, loud and clear. The world's greatest stock picker says that most people should not be picking stocks at all. Instead, just buy a very low-cost index fund. See? He's not being contradictory. He's just being incredibly realistic about who he's talking to. And that brings us to what I think is the most powerful, most useful way to think about this entire discussion. It's not about which strategy is better. It's about which strategy is the right tool for the job you're trying to do. So this is it, the final takeaway. Think of these two strategies as different tools. Concentration, that's a power tool. It's the high-octane engine you use to try and build a massive fortune. It's how people get incredibly rich. But diversification, that's your armor. It's the shield you use to protect the wealth you've already worked so hard to accumulate. The ultra-rich, they use that engine to get to the top of the mountain. Most of us are better off using the shield to make sure we don't fall off. And that leaves us with one last simple question that only you can answer for yourself. What's your goal right now? Are you trying to get rich, or are you trying to stay rich? Are you playing offense, or are you playing defense? Because your honest answer to that one question tells you everything you need to know about which side of the Buffett paradox is the right one for you. All right, when I say Warren Buffett, what's the first thing that pops into your head? For almost everyone, it's value investing, right? You know the image, the wise old man from Omaha who just buys these boring, supposedly cheap stocks. But here's the thing. What if that whole narrative, the one you hear everywhere, is just wrong? Or at least it's not the whole story. Let's dig in, because the truth behind how he thinks is way more fascinating. And look, Buffett himself basically tells us this. This quote right here is the key. He's saying that investing isn't some simple formula where you just slap a value or growth sticker on something. Nope. It's about rolling up your sleeves and doing the hard work of analysis. It's messy, it's full of nuance, it's definitely not black and white. And understanding this one idea, well, that's going to unlock everything for us. Okay, so here's how we're going to break this all down. First, we'll tackle that big divide between value and growth. Then, we've got a great story about two totally different stocks. After that, we'll get into the investor mindset, reveal what I'm calling Buffett's secret weapon. And finally, we'll figure out what it really means to buy stocks cheap. All right, part one. Let's get into the big one, value versus growth. We got to start here because these are the labels Wall Street just loves to throw around, and they set the stage for everything else. So the way Wall Street usually sees it, the stock market is split into two big camps. You've got your value stocks. These are the ones with low price multiples, a low price to earnings, price to book, that sort of thing. Basically, they look cheap on paper, kind of like the reliable family sedan. On the other side, you've got growth stocks. These are the flashy sports cars. Their price multiples are sky high because investors are betting they're going to grow like a weed. And this, right here, is where the myth comes from. Everyone just assumes that because Buffett has bought some companies that looked cheap, he must be the king of value investing. He gets stuffed into that box. But you know what? That box is way, way too small for him, as we're about to find out. So let's really put this to the test. I've got a great little story for you, a tale of two stocks. And this is where that whole myth about Buffett just completely starts to unravel. Okay, so our story has two main characters. In this corner, you've got the tech giant, the disruptor, Google. And in the other corner, a true media institution, a pillar of the old guard, the Washington Post. So here's the deal. The Washington Post, this was a classic Buffett investment. He held it for decades, and it delivered an absolutely insane return, over 11,000%. And then you have Google. Went public in 2004, became maybe the biggest growth story of our lifetime, and Buffett never touched it, not once. Now, Let's look at the numbers, because this is where it gets really interesting. If we rewind to September 2007, check this out. For every dollar of earnings Google made, investors were willing to pay $48. For the Post, only 25. That's almost double. And look at the sales multiple. 13 times for Google, less than 2 for the Post. I mean, by any classic yardstick you want to use, Google was just a ridiculously expensive stock compared to the newspaper. So why? Why would people pay so much more for Google? Well, this chart explains everything. It all came down to expectations. The market figured, okay, the Washington Post, it'll grow its earnings maybe 8% a year. That's nice. But Google, whoa. The expectation was for 30+% growth, year after year. It was just a monster. People weren't paying for what Google was, they were paying for what it was going to become. So that's the big puzzle, isn't it? Why on earth did Buffett, the master investor, put his money on the slow and steady newspaper instead of the tech rocket ship that was literally taking over the world? The answer to this question, well, it tells you everything you need to know about how he really operates. Okay, to figure this out, we have to stop looking at spreadsheets for a second. We need to get inside the investor's head, because this isn't just about the numbers, it's about two completely different ways of thinking, two totally different psychologies. You know how the media paints this picture, right? You've got the gunslingers, the growth investors, they're all about speed, jumping in and out of hot stocks, always chasing the action. Then you've got the wise elders, the value investors. They're patient, they do their homework, they think for the long term. Now, yeah, these are stereotypes, but there's a kernel of truth there about the different approaches. I love this analogy. Think about being stuck in a massive traffic jam. The growth driver? That's the guy who's getting all worked up. He's constantly weaving between lanes, tailgating, honking, just creating a ton of stress and probably not getting there any faster. The value driver, on the other hand, is calm. He pulls up his mop, sees an alternate route, and just quietly gets off the highway. It might not be the most direct path, but it'll get to his destination with way less stress. There is no doubt which one of these drivers is Buffett. All right, now we're getting to the heart of it. We've seen the myth, we've looked at the puzzle, now it's time to pull back the curtain and see what's really going on. And it all boils down to this. For years, we've all been asking the completely wrong question. See, the real question isn't, is this a value stock or a growth stock? That's the trap. The real question, the one Buffett is always asking, is much simpler and way more profound. It's, is it undervalued? Is the company on sale for less than what it's actually worth? That's it. That's the entire game right there. And here's what that means. An undervalued stock can be literally anything. It could be a fast-growing tech company, a slow-growing newspaper, anything in between. The label doesn't matter. All that matters is one thing, that the market has made a mistake and put the wrong price tag on it. The price you see on the screen is less than its real, true worth, what we call its intrinsic value. So how in the world does he figure out that true worth? Well, it's not by looking at simple PE ratios. He uses a serious piece of financial machinery, what you could call his secret weapon. It's called discounted cash flow analysis, or DCF for short. Okay, I know this sounds super technical, but stick with me, because the idea is actually pretty straightforward. It's basically a 4-step recipe. First, you gotta predict the future. You estimate all the cash that business is going to spit out, year after year. Second, you need a discount rate. This is just a way of saying that money you get in the future is worth less than money in your pocket today, right? So you pick a number to account for that. Third, you do the math. You take all those future cash predictions and use your discount rate to pull them all back to a single number today. And that number, that's your best guess at the company's real, intrinsic value. And finally, the moment of truth. You compare your number to the stock price. And if your number is bigger, bingo, you've found a bargain. And that brings us to the final piece of the puzzle. This is the new reality, a much smarter way of looking at investing that gets us past all those useless labels. If you remember one thing from all of this, let it be this slide right here. There is a huge difference between buying cheap stocks and buying stocks cheap. Buying cheap stocks is just looking for a low PE ratio. It's superficial. But buying stocks cheap, that's about doing the work to figure out what a company's worth, and then buying it for less than that number. It sounds like the same thing, but I promise you it is a world of difference. So let's just wrap this all up. First, stop calling Buffett a value investor. He's an undervalued investor. Big difference. Second, Remember that a fantastic business, like Google, can be a truly awful stock if you overpay for it. The price you pay matters. A lot. Third, the whole game is about figuring out that intrinsic value and then insisting on buying it at a discount. That's your margin of safety. And finally, you gotta have patience. You find a bargain, and then you just wait. You wait for the rest of the market to catch up to what you already figured out. So I'll leave you with this to think about. Using this new lens, take a look at the darlings of the stock market right now. The companies everyone loves, the ones that can do no wrong, and ask yourself that new question. Don't just ask, is this a great company? Ask, is the price so high that it's turned this great company into a terrible stock? It's a powerful question to ponder.
All right, let's dive right in. Today, we're tackling one of the biggest, oldest debates in all of finance: value investing versus growth investing. Is the best path to building wealth a slow and steady marathon, or is it a full-out, high-speed sprint? We're going to dig into the strategies, look at the hard data, and hopefully, by the end, you'll have a much better idea of which race you're actually built to run.
You gotta love this old Wall Street saying because it just gets right to the heart of the matter. You know, when the market's on a tear and everything's going up, it is so easy to feel like a genius. But this quote is a great reminder that a rising tide lifts all boats, even the leaky ones. Real investing skill, a true strategy, that's what separates genuine success from just getting lucky.
And that really sets up the big question for today, the one we're going to keep coming back to, based on that classic fable. In this big race for returns, what's your style? Are you the tortoise? Slow, steady, patient, building wealth over the long haul? Or are you the hare, sprinting, looking for those quick, explosive gains? It might seem like a simple question, but how you answer it, well, that could shape your entire financial future. Okay, so here's how we're going to break it all down for you. First, we'll get on the same page and define what we actually mean by value and growth. Then, we'll look at the evidence. Who's the long-term champion? After that, we'll see when the short-term sprint can actually win the race. Then, we'll throw another big variable into the mix: company size. Does it matter? And finally, we'll pull it all together to help you figure out your own path forward.
All right, first up, value versus growth. You know, at the end of the day, this is really the fundamental choice every single investor has to make. It's really a question of your core philosophy. Are you out there hunting for a bargain, a solid, good company that the market has just kind of overlooked? Or are you betting on the next big thing, the company that has all the buzz and is poised for explosive growth? Let's dig in.
And when you think of value investing, I mean, one name immediately comes to mind, right? Warren Buffett. The man is a legend for a reason. His entire philosophy, his whole career, is built on this one simple, powerful idea: find wonderful businesses and then buy them for less than they're actually worth. He's the ultimate bargain hunter, always looking for a great company that's on sale.
This really breaks it down perfectly. I like to think of it like this. Value stocks, they're kind of the wallflowers at the big market party. They're often ignored, maybe in an unpopular industry, and because of that, they trade at low price multiples. The whole game is to find that hidden gem and buy it for less than its true intrinsic value. Now, growth stocks, they're the complete opposite. They're the life of the party. They're popular, they're exciting, everyone's talking about them. And all that hype pushes their prices and their multiples way, way up. For a value guy like Buffett, that popularity is usually a huge red flag that a stock is just too expensive.
So, okay, Buffett's track record is, well, it's legendary. It makes a really compelling case. But is he just a total outlier? A once-in-a-generation genius? Or is there something more to it? Is there actual hard data that proves that value investing is the long-term champion? Well, that brings us to our next section, the power of patience.
And that's the multi-billion-dollar question, isn't it? Does this strategy actually work for people who aren't named Warren Buffett? You know, anecdotes are one thing, but we need cold, hard data. And it turns out the answer is a huge, resounding yes, thanks to a landmark study that really changed how we think about the markets.
The answer came from this absolute landmark study by two legends in the field, Eugene Fama and Kenneth French. Here's what they did, and it's pretty brilliant in its simplicity. They took 27 years of U.S. stock data. They sorted every single stock into one of 10 groups based on how cheap or expensive it was, basically from extreme value to extreme growth. And then they just watched to see what happened to each group over the next 10 years.
So what happened to those stocks? The ones nobody wanted, the cheapest of the cheap, the most extreme value stocks. After 10 years, they were up almost 7 times. Just let that sink in for a second.
Let's put that in perspective. A nearly 7x return over a decade works out to an annualized return of about 21%. That's just incredible. It's right up there with Buffett's own legendary performance. And the hares, the most exciting extreme growth stocks, they returned less than 8% a year. I mean, over 10 years, the tortoise didn't just win, it absolutely crushed the hare.
But you might be thinking, okay, that's great for the US market, but what about the rest of the world? Well, Fama and French asked that exact same question. So they ran the same tests on 12 other major markets around the globe. And the result? Value beat growth in 11 out of the 12. The only weird outlier? The one place where the hare actually won? Italy. To this day, nobody's quite sure why. But for the rest of the world, the tortoise reigns supreme.
All right, so the case for long-term value investing, for being the tortoise, looks pretty rock solid. But that can't be the whole story, right? What about the hare? There have to be times when speed wins. And that brings us to our next section, the short-term sprint, and when the hare finally gets its revenge.
So, does this mean growth investing is just always a bad idea? Not at all. It turns out the hare can absolutely win, but you have to be running a completely different race. It's all about your time horizon. While value wins the marathon, growth can definitely win the sprint.
And we need to be really, really clear here. When we say short-term, we are not talking about day trading, that super high-stress world of in and out in minutes. No. We're talking about a real, evidence-based strategy called momentum investing. This is all about spotting a powerful trend in a stock and riding that wave for maybe 6 to 18 months.
So, how do you spot one of these powerful trends? Well, the pros have a tool for this, a little piece of jargon called SU, that's Standardized Unexpected Earnings. It sounds complicated, but the idea is simple. Wall Street analysts are always guessing what a company will earn. SU measures when a company doesn't just beat those guesses, but absolutely blows them out of the water. A huge SU score is like the starting pistol for a big upward move.
And here's the kicker. This is where it all ties together. The research shows that the stocks with the most powerful momentum, the ones that are the best sprinters over that 6 to 18-month period, are very often growth stocks. And not just any growth stocks. They're the ones with the biggest, most positive earnings surprises, the ones with the massive SU scores.
Okay, so we've got the long-term tortoise and the short-term hare. But there's another huge piece of the puzzle we haven't talked about yet, one that can change the results for both of them. Which brings us to a really important question. Does the size of the company you're investing in actually matter?
And who better to talk about size than the big guy himself, Warren Buffett? He has flat out said that as his company, Berkshire Hathaway, has become this massive giant, it's gotten much, much harder to get those incredible returns. It's just simple math. It's way easier to double $1 million than it is to double $100 billion. Size can actually become a handicap.
And guess what? The data from that same Fama and Friends study backs them up completely. When they sorted stocks by size, the results were just crystal clear. Over 10 years, the smallest companies ran circles around the biggest ones. The tiniest stocks were up almost 6 times, while the giants of the market couldn't even manage to triple. It's not even close.
And this leads us to what you could call the Buffett paradox. Think about it. We've just seen that long-term, value beats growth, and small companies beat big companies. So the absolute best place to be, logically, should be in small-cap value stocks, right? But here's the problem for Buffett. His company is just too massive. He can't invest in small companies because to make a real difference to his portfolio, he'd have to buy the entire company and then some. He has to buy the big guys, even though he knows the data says the smaller ones do better.
Which brings us to the final section, and honestly, the most important one. How do you take all this information and actually apply it? How do you figure out your own strategy? What kind of investor are you?
This little chart here is a great cheat sheet. It puts everything side by side. The tortoise, value investing, is a long-term game. We're talking 5 years, 10 years, or more. The huge benefit? That proven, data-backed, long-term outperformance. The effort is pretty low. It's mostly buy and hold. The biggest risk is losing patience. Now, the hare, growth and momentum, that's a short-term sprint. The potential for faster gains is the big draw, but it takes a lot more effort. You have to constantly be watching, researching, and trading more often, and all that activity comes with higher risk.
So, it all comes back to that first question, doesn't it? The tortoise or the hare? We've seen the evidence. We've seen what works over the long haul and what can work in short bursts. The real question isn't about which strategy is best in a vacuum. It's about which one is best for you. It's a personal decision that comes down to your own timeline, your goals, and most importantly, your own personality. So, Do you have the deep, deep patience of a long-term investor or the focused urgency of a short-term trader? The choice is yours.
You've probably heard the old saying, right? Never marry a stock. It's classic Wall Street advice, a warning to keep your emotions in check, to not fall in love with a bad investment. But what if I told you that maybe the greatest investor of all time, Warren Buffett, built his entire empire by doing the exact opposite? Yeah, it's a huge paradox, and we're going to dig into it right now. And here it is, straight from the man himself. Listen to those words. Regardless of price, we have no interest at all in selling. That's not the language of a trader. That's not someone looking for a quick flip. That sounds an awful lot like a marriage vow, doesn't it? He's basically saying that when you own a truly great business, the day-to-day noise of the market just doesn't matter. This right here is the puzzle we need to solve. So here's our game plan. First, we're going to tackle the Buffett paradox head-on. Then, we'll dive into this whole idea of marrying an investment and see how that compares to how most people just date their stocks. After that, and this is the important part, we'll uncover the huge advantage that lets Buffett play by these rules. And finally, we'll wrap it all up by figuring out what this means for you and your strategy. All right, let's get into it. Section 1, the Buffett paradox. You know, the image most of us have of Warren Buffett is this guy who's just a master at picking winning stocks. But that picture, well, it's not really the full story. He's just not the stock picker you think he is. It's almost the first thing anybody says about him, right? Oh, Buffett, he's a genius stock picker. But here's the kicker. He would probably be the first person to correct you. And it's not because he's being humble. It's because that label, stock picker, completely misses the whole point of what he actually does. And this, right here, is the key to everything. He's not a stock picker. He's a business buyer. You see, for Buffett, a stock isn't just a ticker symbol blinking on a screen. It's not a lottery ticket. It is a small piece of ownership in a real, living, breathing company. A company with buildings and employees and products. If you can grasp this one single idea, you're on your way to understanding his entire philosophy. Which leads us perfectly into our big idea for today, investing as marriage. And look, this isn't just some cute phrase. It's a whole framework that's built on a really deep, long-term commitment. Just look at these questions. These aren't about what the stock chart did yesterday. These are the kinds of serious, probing questions you'd ask before you make a huge life commitment. He's doing some intense homework, asking things like, what does this company actually make or do? Who are its most critical partners? Can it defend its turf? And maybe most importantly, can I trust the people running this place to be my partners for the next 20 or 30 years? See, he's not just buying a stock, he's vetting a potential life partner. And wow, this quote, this shows you just how deep that commitment runs. It's from Berkshire's own owner's manual. He is openly admitting that his loyalty, his refusal to just dump the weakest business in the portfolio, actually hurts his overall financial performance a little. Any other rational investor would sell in a heartbeat. But for Buffett, it's a marriage. You stick it out for better or for worse. That is just a world away from how most of Wall Street thinks. Okay, so if Buffett is looking for a marriage, what is everyone else doing? Well, that brings us to our third section. See, most investors, they're just dating their stocks. They're always keeping their options open. And we're back to this old mantra. This is the philosophy that drives pretty much the rest of the market. The thinking here is that commitment is a weakness. You gotta be nimble, right? Ready to break up the second things don't look perfect. Or maybe when a more attractive stock comes along. No mess, no fuss, just a quick sell order and you're on to the next one. Let's put these two philosophies side by side, because the difference is just night and day. The marriage approach, the business buyer, is focused on the real underlying value of the company, not what the price is today. The commitment is for decades, so an exit strategy, they don't even think about it at the beginning. The viewpoint is of an owner. Now, the dating approach is the total opposite. The focus is almost 100% on that constantly changing market price. The commitment is temporary, so having an exit plan isn't just a good idea, it's absolutely crucial. And the viewpoint is that of a trader. We're talking about two completely different worlds here. Okay, so you might be thinking, well, the marriage approach sounds better. Why doesn't everybody just do that? And that brings us to maybe the most critical part of this whole explainer, the billionaire's advantage. Because there is a very real, very powerful reason why you can't just copy and paste the Warren Buffett playbook. So let's just ask the question straight up. When you get right down to it, beyond the billions and the decades of wisdom, what is the one fundamental thing that separates you, the average investor, from Warren Buffett? The answer is one single word. And believe me, this word changes everything. Control. Buffett doesn't just own a stock certificate. In many cases, he owns enough of the company to actually control its destiny. And to put that into perspective, look at this number, $10 million. That's what it costs to get a tiny 1% stake in what the market considers a small public company. You and I will likely never have the kind of money needed to buy a truly meaningful, controlling piece of a business. We buy shares. Buffett buys influence. And with that influence comes some serious power. If Buffett thinks the CEO is doing a bad job, he can work to get him fired. If he thinks the strategy is wrong, he can force them to change it. He can get a seat on the board of directors. When you buy 100 shares of a company, you can't do any of that. You're just a passenger. Buffett isn't just on the ship. He can actually grab the wheel and steer it. And his advantage doesn't even stop there. He has access to these exclusive tools, like something called a pipe deal. Basically, it lets a massive investor like Berkshire just sidestep the public stock market and cut a private deal directly with a company. And they often get to buy shares at a huge discount to the price you or I would have to pay. It's a VIP club, and we're not on the list. Okay, so what in the world are we supposed to do with all this? This is where we bring it all home. The takeaway here isn't to give up. It's to build your strategy, not his. The goal is to learn from his principles, but not try to perfectly imitate his practice. I absolutely love this quote from Ken Fisher, whose father was actually one of Buffett's own mentors. It is such powerful advice. You don't have Buffett's billions, his influence, or his access to private deals. So trying to be a carbon copy of him is a game you're destined to lose. The real goal is to be the best version of yourself as an investor. So let's boil this all down into 4 real, actionable takeaways. Number 1, because you can't steer the individual ships, you need a fleet. Diversification is your number 1 tool for managing risk. Number 2, absolutely steal his principle of being a business buyer. Do your homework, buy great companies when they are on sale. But number 3, and this is so important, you have to be willing to get a divorce. Unlike Buffett, you can't fix a broken company. So when a stock gets way too expensive or the business starts to go south, you need an exit plan. And finally, number 4, all of this depends on you knowing yourself, your goals, your timeline, your stomach for risk. Your strategy has to be tailor-made for you, not for a billionaire in Omaha. And that brings us to the final question, the one I want you to really think about after this. Take a hard look at your own investing style. Are you an investor who dates your stocks or one who marries them? And after everything we've talked about today, the more important question is, given who you are and the tools you actually have, which one should you be? When you hear the name Warren Buffett, what comes to mind? For most of us, it's this image of the Oracle of Omaha, right? This folksy, grandfatherly genius who makes these colossal billion-dollar decisions that seem to come from some kind of mystical intuition. Well, today, we're going to pull back the curtain on that legend. We're going to deconstruct the myth and really get to the heart of the method behind all that magic. Let's jump in. I mean, this quote is just classic Buffett. It's the story of how Berkshire Hathaway acquired Forest River, a huge RV manufacturer. A simple 2-page fax shows up in the morning, and by the afternoon, a deal is already on the table. It sounds so incredibly casual, doesn't it? Like he's ordering a book online, not buying a massive company. And that really is the million-dollar, or I guess billion-dollar question, isn't it? Can the world's most famous investor really operate this way? Is it all just a gut feeling, or is there a much deeper, much more calculated reality hiding behind these incredibly simple stories he tells? So, to figure this out, here's our game plan. We'll start with what I'm calling the Buffett paradox. Then, we'll dig into these legendary 24-hour deals. From there, we'll look at what's really happening behind that so-called gut decision. We'll also see how his playbook has changed over the years. And finally, we'll wrap it all up with the real lessons we can take away from the Oracle himself. Okay, so let's get right into it with this central conflict, this paradox that surrounds his public image. Is he a gunslinger, making these huge bets based on pure instinct? Or is he more of a patient, calculating machine, just waiting for that perfect, pitch-perfect moment to act? This right here really lays out the massive difference between the myth and the actual reality. The myth paints this picture of a guy making snap decisions, but the truth, it's so different. For example, in 2004, Berkshire made absolutely zero significant acquisitions. In Buffett's own words, he struck out. He's not out there hunting for deals. He's more like a fisherman, patiently waiting for the right deal to come to him. Okay, so if he's actually this incredibly patient investor, where in the world did this myth of the lightning-fast decision come from? Well, let's dive into the legendary case studies that built his reputation as a quick-draw investor. And our first case study is the big one, the one we started with, Forest River. At the time, they were a major player in the RV market, and their story is the perfect example of the Buffett myth in action. Just look at this timeline, as told by Buffett himself. It's just incredible. A fax lands on his desk one morning. The next day, he gets a few more numbers, and by that same afternoon, an offer is made. For a deal of this size, that's not just fast, it's practically the speed of light in the business world. And let's be clear, we are not talking about some little mom-and-pop shop here. The speculated purchase price was over $800 million. That is a massive, company-altering decision, and it was apparently made in the time it takes most of us to figure out what we want for dinner. You hear a story like that, and it just raises a ton of questions, right? Where was the due diligence? The weeks and months of deep dive investigation into a company's books. What was the big rush? Was he worried about someone else swooping in? Is this just a reckless gamble? Or is there some level of genius at play here that we're just not seeing on the surface? And you might think, okay, maybe Forest River was just a one-off, a fluke. But it wasn't. The acquisition of Business Wire, the corporate news distributor, followed almost the exact same script. The CEO at the time, having heard the Forest River story, sent Buffett her own 2-page letter, and bam, history repeats itself. So the pattern is definitely there, but the logic, that's what we still need to figure out. All right, now let's start to peel back the layers of this myth. It's time to reveal the machinery that's really at work here. Let's see what's actually going on behind the curtain when one of these simple deals happens. This quote really just cuts right to the chase. As fantastic and compelling as these stories are, there is just no way it's the whole truth. It cannot possibly be this simple. There has got to be more to it. And this brings us to a really crucial, kind of legal-sounding concept, but it's so important to understand: fiduciary duty. As the CEO of a publicly traded company, Warren Buffett has a legal and ethical obligation to act in the best interests of his shareholders. Making billion-dollar bets based on a whim would be like a surgeon operating blindfolded. It's not just irresponsible, it's a massive betrayal of trust and his legal duty. And here it is. This is the hidden truth. While Buffett is the face of the deal, focusing on the big picture stuff like the business model, the quality of the management team, you can absolutely bet that there is a whole team of brilliant analysts at Berkshire Hathaway crunching every last number, running all the models, and doing that deep financial dive that's absolutely necessary before any deal gets a green light. That simple story he tells, it's just the very tip of a very large, very well-analyzed iceberg. Now, what's really cool is that this deeply calculated approach actually gives Buffett the flexibility to evolve his strategy, to push himself and Berkshire into new, sometimes unexpected territory that seems to fly in the face of his own long-held rules. A perfect example of this evolution is the acquisition of a company called Iskar Metalworking. For decades, Buffett was famously a Buy American investor. This deal was his first major step onto the global stage, and believe me, it was a total game changer for Berkshire. And this is where things get really wild. His first big foreign investment wasn't in some safe, stable country like Germany or the UK. Nope, it was in Israel, in a town right near the Lebanese border. The $4 billion deal for 80% of the company closed just 1 week before a regional conflicts broke out. Talk about a high-stakes move. And yet, how did this incredibly complex, risky deal all begin? You guessed it, with a simple letter, this one just 1.25 pages long. Okay, let's bust another huge cornerstone of the Buffett myth, this idea of buy and hold forever. It sounds great, it makes for a good soundbite, but when you actually look at his portfolio of publicly traded stocks, a very, very different picture starts to emerge. I mean, just look at this list. Since the year 2000, Berkshire's public portfolio has seen a surprising amount of churn. We're talking huge household names like Citigroup, Disney, Best Buy. They've all been bought and sold. This is not the work of some passive investor who just buys a stock and forgets about it. This is an active manager who is not afraid to sell when an investment no longer makes sense, whether that's because the business changed, the competition got tougher, or simply because a better opportunity came along. So now that we've kind of torn down some of these myths, what's left? What are the actionable lessons we can take away from the master himself? Let's get into the real Buffett playbook. Okay, here it is, the real playbook. Number 1, Be patient. Don't let that cash burn a hole in your pocket. Just wait for the perfect pitch. 2. Do your homework. Those simple stories are built on a foundation of incredibly deep analysis. 3. Bet on people. Buffett invests in companies with fantastic management that he trusts will stick around. He's buying their talent just as much as their balance sheet. 4. Think globally. The Oscar deal proved that amazing opportunities are everywhere. And finally, number 5. Don't be afraid to sell. Even the Oracle knows when it's time to move on. And I think this quote from his visit to Iskar in Israel is just so revealing. After all those decades, all those legendary deals, he could still be this impressed by a business. It's such a powerful reminder that at the very core, his mission has always been the same: to find and partner with true operational excellence, no matter where on earth it happens to be. So maybe the ultimate lesson here isn't really about picking stocks or buying companies. Maybe Buffett's greatest skill is building a system of reputation, of principles, of capital that is so powerful and so well-defined that the best opportunities in the world actually come to him. It's a pretty provocative thought, and it kind of leaves us with a question for ourselves. What kind of system are you building to attract your own great opportunities?
You know, every great success story has a few chapters they'd probably rather you just skip. And in the world of investing, even the titans, the absolute legends, have stories of failure. We're talking billion-dollar blunders, gut-wrenching turnarounds. So today, we're going to open the book on some of Warren Buffett's most challenging investments.
I was dead wrong. Just let that sink in for a second. Imagine hearing those 3 words from the man they call the Oracle of Omaha. Now, imagine him saying it not just once, but twice, about 2 completely different, massive investments. It's a really powerful admission, and that's exactly where we're going to start.
So, that's the big question, right? When a deal goes sour, when what looked like a sure thing turns into a black hole for cash, what does Warren Buffett actually do? Does he fight? Does he fold? Well, we're going to dive in and find out.
Here's how we're going to tackle this. First, we'll shatter the myth of the perfect investor. Then, we'll see Buffett become a crisis manager, kind of a corporate firefighter. After that, we'll look at a decade-long turnaround that tested his patience. Then, the flip side, knowing when to cut your losses. And of course, we'll wrap it all up with the key lessons for the rest of us.
Okay, first things first, let's just be crystal clear. No investor, not even Warren Buffett, has a perfect record, and that's totally okay. In fact, I'd argue that understanding his mistakes is just as useful, maybe even more so, than studying his home runs. It just goes to show you that even the best in the world are human.
Now, here's what's so interesting about all this. Buffett absolutely hates getting involved in managing the companies he buys. I mean, his whole philosophy is to find great businesses that already have great managers, buy them, and then get out of the way. But as we're about to see, sometimes a crisis forces his hand. The investor has to become the boss.
And that brings us right to our first case study, the legendary Wall Street firm Salomon Inc. This wasn't just a bad investment. This was a full-blown, existential crisis that threatened to bring down a financial giant, and it forced Buffett to step in and basically become a firefighter.
So the story unfolds really fast. Berkshire puts a massive $700 million into the company back in 1987. 4 years later, boom, a huge scandal involving a rogue trader just explodes. To save the company from going bankrupt, Buffett has to reluctantly take over as the interim CEO. A year later, once he's stabilized the ship, he steps down, and eventually the company gets sold in 1997.
And let me tell you, the stakes here were absolutely astronomical. You had a trader who was illegally manipulating the U.S. government bond market. Worse, management knew about it and didn't report it. So the U.S. Treasury was about to deliver a death sentence, a ban that would bankrupt the firm literally overnight. We're not just talking about one company. This was a potential domino effect that could have rocked the entire global financial system. Buffett had no choice but to step in.
So, after all that drama, right? After becoming the reluctant CEO and pulling the company back from the brink of collapse, what was the result for Berkshire Hathaway? Get this, a stunning 2.5 times their initial investment over those 10 years, a crisis, a total firestorm, and yet, ultimately, a very profitable, if incredibly stressful, success story.
All right, let's move on to our next story, which is a completely different kind of problem. This isn't a sudden fire that needs to be put out. No, this is a slow, grinding, decade-long slog that tests an investor's most important quality, patience.
And we're looking at two companies he bought in the same year, General Re and NetJets.
And right away, this slide shows a bit of a red flag. In 1998, Berkshire bought both of these companies. But notice the payment method, cash and Berkshire stock. Now, this is super unusual for Buffett. He hates, absolutely hates, using his own company's valuable stock to buy other things. It was a subtle sign that maybe these weren't his typical slam-dunk, no-brainer deals.
Now, to understand the General Re deal, you have to understand this concept called float. It's basically the cash that insurance companies collect in premiums that they get to hold on to and invest before they have to pay out any claims. Buffett calls it his secret sauce. And this General Re acquisition tripled Berkshire's float practically overnight. On paper, it looked like an absolute masterstroke.
But that masterstroke very quickly turned into a massive headache. The company got hit by a perfect storm of disasters. A huge $1.9 billion underwriting loss from the September 11th attacks, then the discovery of $800 million in hidden liabilities, and on top of that, a derivatives trading unit that was just bleeding hundreds of millions.
And Buffett, in his totally characteristic way, blamed himself. He said the 9/11 loss showed that he had allowed General Re to violate his own core principles of insurance. They had accepted risks they didn't really understand, and those risks were all correlated, meaning one single event could trigger this horrible cascade of losses. The crucial point here is he owned the mistake.
And there it is again, that phrase. In 2002, talking about the problems at General Re, he says, "I was dead wrong." Then just 3 years later, describing the struggles at the other company he bought with stock in '98, NetJets, he uses the exact same words. That echo, that repetition, it just tells you everything you need to know about how deep these problems ran.
NetJets was a very similar story, just a slow, painful burn. The business was growing, revenues were going up, but it was a capital-intensive nightmare. Expanding into Europe was way more expensive than he ever anticipated. They were losing money chartering other companies' planes just to meet demand in the US. And they were constantly having to buy these new multi-million-dollar jets. It was basically a machine built to burn cash.
So, okay, we've seen Buffett the firefighter and Buffett the incredibly patient turnaround artist. But what happens when a business just can't be fixed? Well, this next story teaches a very different lesson, one about knowing when to admit defeat and just get out. This is the story of Pier 1 Imports. So Berkshire started buying up shares in Pier 1 back in 2004, just as the company's fortunes were about to take a nosedive. And just look at this. In fiscal 2004, they made $118 million. Just 2 years later, they were losing almost $40 million. The business was falling apart and fast. And this is where Buffett's famous pragmatism really shines through. He started buying in the second quarter of 2004. By the third quarter of 2005, we're talking just over a year later, he was already selling. He didn't wait around for years hoping for some magical turnaround. He saw his mistake, and he moved decisively to cut his losses. So, after walking through these billion-dollar corporate dramas, what's the big takeaway, right? What can we actually learn from the Oracle's errors? This, to me, is where the real wisdom is found.
Okay, so the Salomon story, that shows us that a really rocky start doesn't necessarily doom an investment. General Re and NetJets, they're a huge warning to be skeptical when a company uses its own stock to buy stuff and to steer clear of those capital-intensive businesses. And the Pier 1 story? That's a powerful reminder that a falling stock price isn't always a bargain. But I think the biggest lesson of all is just having the humility to admit when you're wrong and the courage to actually do something about it.
Buffett has this incredible knack for making lemonade out of lemons, right? He did it with Salomon and eventually with General Re. But the Pier 1 saga, that teaches us a much more grounded lesson. Sometimes a lemon is just a lemon, and the smartest thing you can do is just throw it away before it spoils everything else. And that really leaves us with a final question to think about. What we've seen here are two very different kinds of strength. On one hand, you have the incredible patience to stick with a problem for a decade, like he did with General Re. And on the other hand, you have the cold, hard courage to admit a mistake and just walk away, like with Pier 1. So which one do you think is harder?
Who watches the watchers? It's a question that's as old as ancient Rome, but it is absolutely at the heart of modern capitalism. We're talking about corporate governance, that whole system of checks and balances that's supposed to make sure a company is run for its real owners, you, the shareholders. And to really wrap our heads around this, to see past all the textbook definitions, there is no better case study than the company built by the world's most famous investor, Warren Buffett. All right, let's get into it. We really have to start right here with this quote, because it is pure Buffett. In just one sentence, he completely flips the script on what everyone thinks they know. See, the very people who are supposed to be these independent, objective watchdogs on a corporate board, he's suggesting they might actually be the most conflicted, that they're more worried about keeping their high-paying board seat than they are about what's best for the company. It's a really provocative idea, and it's absolutely key to understanding his entire way of thinking. And that quote leads us straight into what I like to call the Buffett paradox. Think about it. On one side, for more than 50 years, Warren Buffett has been the biggest, loudest champion for shareholders in America. I mean, he has written these scathing, brilliant takedowns of overpaid, lazy CEOs. But here's the paradox. For most of its life, his own company, the legendary Berkshire Hathaway, has looked like a poster child for bad corporate governance. It's broken almost every rule in the book. So how can the ultimate shareholder advocate run a company that seems to completely ignore all the standard shareholder protections? Now, to solve that paradox, we need a little bit of context. So let's wind the clock back to the early 2000s. The business world was just completely rocked by these massive scandals. Enron, WorldCom. These weren't just companies that made bad bets. This was catastrophic failure of oversight, built on lies, and frankly, enabled by boards that were either asleep at the wheel or worse, in on the whole thing. Public trust was just gone, and everyone from Wall Street to Washington was asking the same terrifying question: who is supposed to be watching the CEO? So the answer that came out of all that wreckage was this formal set of rules, what you could call the good governance playbook, designed specifically to prevent another Enron. And to really appreciate just how radical Buffett's approach is, we first have to understand the conventional wisdom, the very rules that he seemed to happily ignore for decades. So let's be really clear what we're talking about. Corporate governance exists to solve this one fundamental conflict at the heart of every single public company. The people who own it, the shareholders, are not the same people who run it day to day. That's the management, right? You might own a piece of the company, but the CEO is the one flying the plane. And governance? Well, that's the entire system of rules and relationships that's supposed to make sure the pilot is flying to the destination that all the passengers actually paid for. And this, right here, this is what makes that conflict of interest so painfully clear. Let's just say a CEO owns 1% of their company's stock. Now, if they decide to use company money to buy, I don't know, $1 million corporate jet they don't really need, well, the company is out $1 million. But the actual financial hit to that CEO's personal wealth, it's only $10,000. You can see how that's a crazy powerful incentive to put your own perks ahead of shareholder value. It's the perfect reason why we need strong oversight. So to fix this exact problem, the experts and the regulators came up with this checklist. This became the gold standard. A good board, they said, has to have a majority of independent directors, people with no ties to the company. The powerful jobs of CEO and chairman, they should be split. The board should meet in private, without the CEO there, so they can have frank discussions. This wasn't just friendly advice. This became the official playbook that every public company was judged by. And this brings us right back to Buffett. He looked at this whole playbook, this entire complicated system of rules and procedures, and he basically said, you guys are measuring all the wrong things. For him, good governance wasn't about checking boxes and avoiding conflicts. It was about creating a perfect alignment of interests through one simple, powerful idea: having skin in the game. This chart just lays out the huge difference in thinking perfectly. The official view defines an independent director by what they are not. Not an employee, not a family member, not a major customer. It's a definition based on absence. Buffett's view is the complete opposite. He defines a truly useful director by what they are: a big-time passionate owner. For him, real independence of thought doesn't come from a lack of relationships. It comes from having so much of your own money on the line that you will fight tooth and nail to protect it, which by extension protects all the other shareholders too. And here's the hidden danger Buffett sees in that official definition. Just think about it for a second. Imagine you're a director on a big company's board. You're making, let's say, $300,000 a year in fees. It's a big part of your income. Then, an amazing offer comes along to buy the whole company at a huge premium. It's a fantastic deal for shareholders. But if the company gets sold, the board gets dissolved, and your $300,000 a year gig, it's gone. Poof. In that moment, are you really an independent voice for shareholders, or are you just an employee trying to protect your own paycheck? For decades, Buffett ran Berkshire Hathaway as the ultimate skin-in-the-game company, and you really can't argue with the results. But even the Oracle of Omaha couldn't hold back the tide of regulation forever. The post-Enron world eventually came knocking on his door too. So let's see how this whole philosophy actually played out and how it was eventually forced to change. Okay, just look at this. This is a snapshot of Berkshire's board back in 2002. According to the official playbook, this is a 5-alarm fire. It's a complete governance nightmare. The CEO is also the chairman. His wife is on the board. His son is on the board. His lifelong business partner's there. His lawyer's there. I mean, pretty much nobody on this list would pass the official test for independence. And yet, this was the board that oversaw one of the greatest periods of wealth creation in modern history. So what happened? Well, the world changed. The regulatory backlash after all those scandals was huge. In 2003, the New York Stock Exchange, where Berkshire's stock is traded, just laid down the law. Their new rule, Section 303A, was crystal clear. If you want to be listed on our exchange, your board of directors must have a majority of independent members, period. The debate was over. The rules were the rules. Buffett's old model was simply no longer a legal option. And here's what happened because of that new rule. The board got bigger. New directors were brought in who met that strict NYSE definition of independent, including, most famously, Buffett's friend and fellow billionaire Bill Gates. All of a sudden, Berkshire was in compliance. Now, this was a major structural change, but it's really important to get this. It was a change in form, not in philosophy. Buffett didn't suddenly have a change of heart and decide the playbook was right. He just complied with the rules of the game because he had to. Okay, so this brings us from the structure of the board to what is, for Berkshire Hathaway, the absolute ultimate governance question. It's the question that's been whispered in financial circles for decades. The board is one thing, sure, but what happens when the one-of-a-kind, iconic genius who built the entire empire from scratch is gone? Who exactly is the next Buffett? It is a question that just hangs over Berkshire like no other. Because you see, Buffett isn't just a brilliant CEO who runs all the operations. He's also a brilliant chief investment officer who decides where to put all its massive piles of capital. He really is the sun that the entire Berkshire solar system revolves around. So how in the world do you even begin to plan for a future without a figure like that? It is without a doubt the single biggest test of Berkshire's long-term governance. So after years of being pretty cagey about it, pressure from investors and regulators finally led to some clarity. And the plan that they revealed is actually elegantly simple and very logical. Buffett finally admitted that no one person could possibly do his entire job, so he split it in two. The operational side, the CEO role, will go to one of his top internal managers, and the investing side, managing that mountain of cash, will go to a new chief investment officer, or maybe a small team of them. He basically deconstructed the legend into its component parts. And when he described what he was looking for in that investment successor, Buffett basically wrote the world's most fascinating job description. I mean, look at this list. He's not talking about MBAs or PhDs from fancy schools. He's talking about temperament, genetically programmed to recognize and avoid serious risks, emotionally stable. This is all about psychology. He's looking for a person with a very specific kind of intellectual and emotional wiring, someone who can think clearly when everyone else around them is panicking. So, after going through the Buffett paradox, the boardroom drama, and the whole succession plan, what does all this mean for us, for you and me? As we look at our own investments, what are the big actionable lessons we can actually take away from this entire story? Okay, first, always remember the difference between rules and results. The governance playbook might be pretty good at preventing the next Enron, but there's surprisingly little evidence that it actually leads to better stock market returns. Second, when you look at a board, you need to redefine independence. Don't just count the number of directors with a little I next to their name. Ask the Buffett question. Do these people have real skin in the game? Go read the company's proxy statement and see how much stock they actually own themselves. And finally, always think about the star CEO risk. If a company's success seems tied to one irreplaceable person, their succession plan isn't some minor detail. It's one of the most critical things you need to know. Which leaves us with this one last fundamental question. The whole story of Warren Buffett and Berkshire Hathaway is really a masterclass in this dilemma. When we invest our own hard-earned money, where should we put our faith? Should we trust in a carefully constructed rulebook, one that's designed to protect us from the worst parts of human nature? Or should we trust in an exceptional ruler, a leader who is so talented and whose interests are so perfectly aligned with our own that the rules just seem almost irrelevant? There's no easy answer here, but it's the question every single one of us has to wrestle with. All right, when you hear the name Warren Buffett, a lot of things probably come to mind. Value investing, Coca-Cola, Omaha. But I'm guessing a huge fan of stock options isn't one of them. In fact, he's basically seen as their #1 public enemy. But what if I told you that entire story is wrong? The truth is way more interesting, and it all starts with a single quote that pretty much changes everything. So let's just start with this bombshell, shall we? This is a direct quote from the man himself. In 2004, Warren Buffett said that the person who eventually takes his place at the head of Berkshire Hathaway, well, they might get a huge chunk of their pay in stock options. The very thing everyone thinks he absolutely hates. This one sentence just completely flips the script on the popular narrative. And that, right there, is the big question we're going to unpack. How can the guy who became the face of the fight against corporate greed say something like that? It sounds like a total contradiction. To get it, we have to jump in a time machine and go back to an era of just unbelievable excess. Okay, so we're heading back to the 90s and the early 2000s, the height of the dot-com bubble. It was a time of insane stock market gains, for sure, but it was also followed by some shocking corporate scandals that just torched people's life savings. To really get what Buffett's stance is, you have to understand the craziness that fueled his outrage. Just look at this number, 400 times. In just a couple of decades, the pay gap between the CEO's office and an average employee absolutely exploded. It went from about 25 times to a mind-boggling 400 times. And this wasn't just because of bigger salaries. Nope. The rocket fuel for this massive leap was the explosion in stock options. While the bull market was raging in the 90s, not many people were complaining. As long as your own 401k was going up, massive CEO paychecks just felt like part of the ride. But then the bubble burst, and when regular folks watched their retirement savings just evaporate, the mood got ugly fast. People started looking for someone to blame, and their eyes landed right on these executives who were still walking away with fortunes, even as their companies were crashing and burning. And the anger wasn't just about the sheer amount of money. It was this feeling that the game was rigged. You had practices like repricing, which was basically a do-over for executives. If the stock tanked and their options were worthless, the company would just cancel them and issue new ones at the new lower price. Heads I win, tails, we just flip again. Then there was backdating, which was just straight-up cheating, falsely claiming options were granted in the past when the price was lower to guarantee a profit. It was stuff like this that showed executives often had all of the reward with none of the risk that normal investors face. So all this public fury eventually boiled over into this massive knockdown, drag-out fight. And it was all centered on accounting. Yeah, I know, it sounds boring, but trust me, this was a battle for the very soul of corporate honesty, and Warren Buffett was standing right in the middle of the ring. This was the billion-dollar question. See, before this whole debate, most companies didn't have to show stock options as a cost on their main report card, the income statement. They could kind of just tuck the details away in the footnotes where nobody looked. The whole fight was about dragging this cost out into the daylight for everyone to see. Now, Buffett's logic here was just devastatingly simple. He basically said, look, are options a form of pay? Yes. Is pay an expense to the company? Yes. Well, then that expense has to go on the income statement. It's just honest accounting. The other side, though, had a counter-argument that you couldn't just ignore. They said, how can you report a cost when you have no idea what the true cost will be years from now? Any number you put down is just a sophisticated guess. And to be fair, they really had a point. Trying to figure out the value of these employee options is not simple math. It involves these super complex financial models with names like Black-Scholes and Monte Carlo simulations, and you're plugging in all these variables that are, at best, educated guesses about the future. It really is hard to nail down a single precise number. And this table here illustrates the problem perfectly. So a company might give an employee 1,000 options, and based on one of those fancy models, they record an expense of, say, $5,000. But what if the company hits it big, the stock soars, and that employee cashes in for an $80,000 profit? That $80,000 is a very real cost to the company's shareholders, and it makes that original $5,000 expense look like an absolute joke. In fact, some really smart economists argued that if you tried to expense the actual cost, you'd create this totally bizarre situation. They called it perverse. Because the more successful your company is and the higher your stock goes, the bigger the accounting expense you'd have to report. You literally be punishing success in your financial statements. It's a weird thought, right? Okay, so we've got the context, the wild abuses, the fierce accounting war. Now let's finally get to the heart of it all and set the record straight on what Warren Buffett actually thinks about stock options. Let's just be as clear as possible here. The popular idea that Warren Buffett wants to ban stock options, that he thinks they should be eliminated, it's just plain wrong. His entire crusade, his whole fight, was never about the use of options. It was about the dishonest accounting for them and the rampant abuse of them. And hey, you don't have to take my word for it. Here it is, from Buffett himself. He states it plainly. Nobody, not the regulators, not investors, and not him, was talking about restricting their use. His focus was always on transparency. He just wanted the cost to be acknowledged in the books, even if the measurement wasn't perfect. You see, far from wanting to ban them, Buffett actually has a whole blueprint for how to make options better. He's a reformer. He argues for things like a floating exercise price. Basically, the price to buy the stock goes up over time, so an executive only makes money if they create value above and beyond what the company would have done anyway. They don't just get rich for riding a bull market. He also wants restrictions on selling to make sure executives stick around and think like owners, not traders. All of his criticisms were like a laser beam, always aimed at specific abuses. He was against companies just handing out options like candy to their favorite executives. He hated the repricing and backdating that took all the risk away. And he called out a more subtle problem: companies using their own cash for stock buybacks, not because the stock was a good value, but just to pump up the price and make their own options worth more. So in the end, Buffett and his allies won the great accounting war. Mandatory expensing became the law of the land. But as it so often happens when you make big rule changes, the victory came with some pretty significant and maybe unforeseen consequences. And here's the one big thing that Buffett himself got wrong in his predictions. He truly believed that forcing companies to expense options wouldn't actually stop them from using them. He thought if they were a good idea before, they'd still be a good idea. But the real-world evidence shows the opposite. As soon as that rule changed, the use of stock options started to fall. And this created a really crucial trade-off. It was a classic balancing act. On the one hand, the new rule did what it was supposed to do. It seemed to cut down on the worst of the abuses. So that's a definite win. But on the other hand, it also discouraged the use of a really vital tool, especially for the new, innovative companies that often needed it the most. See, the new rule didn't affect all companies equally. If you're a huge, profitable corporation, you can easily absorb that new accounting expense, and you can just offer more cash to attract talent. But if you're a tiny startup with no profits and very little cash, options were your secret weapon. They were how you could convince a brilliant engineer to leave a safe job and take a risk with you. This rule change, unintentionally, handed a big competitive advantage to the big guys and made it even harder for the little guys to grow. All right, so after digging through all of that, what are the main takeaways here? First, the simple headline is almost never the whole story. Buffett isn't the enemy of options. He's a nuanced reformer. Second, the true cost of an option is a genuinely tricky puzzle with no easy answer. Third, and this one is huge, every big solution risks creating new, unexpected problems down the road. And finally, for any of us who invest, the real lesson is to look past the noise. Find the companies that are smart about how they pay their people and truly align everyone's interests for the long run. And that really leaves us with one final big question to chew on. The fight to stop the crazy executive greed of the past was absolutely necessary. But in the process of solving that problem, did we accidentally create a new one? Did we make it harder for the next generation of entrepreneurs to build the great innovative companies of the future? It's a trade-off that's really worth thinking about.
All right, let's talk about a name you definitely know, Warren Buffett. You know, the Oracle of Omaha. He's widely considered the greatest capitalist, maybe of all time, a true genius at making money. Which brings us to a huge, fascinating question. Why in the world does this man say he wants to pay more in taxes? It's a real puzzle, and that's exactly what we're going to unpack right now.
And look, let's be perfectly clear who we're dealing with here. This isn't just some guy who got lucky in the stock market. This is Warren Buffett. We're talking about a wealth creation machine who has made staggering fortunes, not just for himself, but for countless shareholders. As he says himself, he was just born to do this. He's wired for it.
And this is where the story gets really interesting, where we hit the central paradox. The guy who is, without a doubt, one of the best on the entire planet at growing capital, is also one of the most vocal champions for higher taxes on, well, people just like him. It just doesn't seem to add up, right? So what is really going on here?
To really get inside Buffett's head on this, we first need to understand the larger context. This whole debate about taxes in America, it isn't just a simple political argument. It's a deep, fundamental disagreement about what's fair, and it all comes down to one incredibly simple yet impossibly complicated concept. Look, nobody loves paying taxes, but pretty much all of us agree they're a necessary evil. We need roads, a military, schools, the whole shebang, and we generally agree that everyone should pay their fair share. The problem is, that's where the agreement ends. The minute you ask 10 different people what fair actually means, you're going to get 10 different answers, and that's where the fireworks start.
So, when you boil it down, the debate over income tax really splits into two big camps. On one side, you have the progressive tax system. Think of it like a series of steps. The more you earn, the higher the percentage you pay. On the other side, you've got the flat tax. It's much simpler. Everyone, and I mean everyone, pays the exact same rate. Now, of course, if you earn more, you'll still pay more dollars, but the percentage itself never changes.
Now, if you're making the case for a flat tax, the argument usually goes something like this. A progressive tax is just fundamentally unfair because it punishes success. Why should a dollar earned by a high-income person be taxed more heavily than a dollar earned by someone else? The concern is that this kind of system kills the incentive to work hard, to invest, and ultimately it can act like a brake on the entire economy.
Okay, now this is where it gets really fascinating. Take a look at this data from the IRS. Both sides of the debate use these exact same numbers to prove completely opposite points. One side looks at this and says, see, the top 1% is already paying almost 40% of all the income taxes. They're shouldering a massive burden. But the other side looks at the very same chart and says, well, yeah, but they also earn a huge chunk of the total income, so of course they should pay more. It's the same data, but two totally different stories.
All right, with that background, let's circle back to Buffett. He is firmly planted in that progressive tax camp. And if you want a case study in what corporate taxes look like at the highest level, his company, Berkshire Hathaway, is absolutely mind-blowing.
Just try to get your head around this number for a second. In a single year, 2006, Berkshire Hathaway wrote one check to the U.S. government for $4.4 billion. It's a number so large it almost feels fake.
And how do you figure out a bill that huge? Well, you fill out a tax return that is almost 9,400 pages long. I mean, if you ever needed a single image to capture the insane complexity of the American tax code, that's it right there.
And here's the absolute kicker. This corporate giant, the company that's writing billion-dollar checks and filing tax returns the size of a small library, it's all run out of a headquarters with just 19 people. 19. It's a perfect illustration of Buffett's legendary, almost absurd efficiency.
So you'd think a guy paying a $4.4 billion tax bill would think corporations are paying plenty, right? Nope, not Buffett. His big complaint is that as a group, corporations just aren't pulling their weight the way they used to. He'll point out that back in the 1950s, corporate taxes made up about a third of all federal revenue. By the early 2000s, that had collapsed to just over 7%, and in his view, that just shifts the burden onto regular people.
And he didn't just talk about this, he took very public stands. Back in 2003, there was a big move to get rid of the tax on stock dividends. Buffett wrote a famous op-ed where he just tore into the idea, calling it a massive giveaway to the rich. And then he dropped a bombshell. He calculated that if that tax was eliminated, his own personal tax rate would fall all the way down to just 3%.
Now, to be fair, there is a very powerful counterargument here. It's called double taxation. And the idea is pretty simple. First, a company like Berkshire Hathaway makes a profit, and the government taxes it. That's tax number one. Then, the company uses what's left over to pay a dividend to its shareholders. When that money hits the shareholders' account, the government wants to tax it again. So the argument is that the very same dollar of profit is getting hit with taxes twice.
But this whole thing goes even deeper. We've talked about income and investments, but Buffett is also a huge advocate for an even more polarizing tax, one that really gets right to the heart of this entire contradiction.
We're talking about the estate tax. It's a tax on a person's net worth after they pass away. And you know a subject is controversial when the two sides can't even agree on what to call it. One side calls it the wealth tax, arguing it's a way to prevent the formation of a permanent aristocracy. The other side calls it the death tax, arguing it's an unfair government grab that punishes a lifetime of saving and building.
And on this issue, Buffett is crystal clear. He does not beat around the bush. He believes that huge fortunes should not just be passed down from generation to generation untouched.
He's on the record saying that a big chunk of that money should go back to the government, back to society when a wealthy person dies.
And here, this is where the paradox becomes impossible to ignore. In 2001, you've got Buffett publicly fighting against efforts to get rid of the estate tax. He wants to keep it. But then, just 5 years later, he pledges the vast majority of his fortune, we're talking $37 billion, to charity. And what does that do? It's a perfectly legal, even admirable move that also ensures his estate will pay practically $0 of the very tax he fought so hard to protect. So you just have to ask, right? It's the multi-billion-dollar question staring us in the face. If he's such a believer in the estate tax, why did he engineer one of the most brilliant moves in history to make sure he'd never have to pay it?
Okay, let's try to put the pieces together. How do we solve this puzzle? And more importantly, what can we as investors and just regular people trying to figure things out learn from all this?
Well, obviously, no one can truly know what's in Warren Buffett's mind, but the most logical explanation seems to be this. He believes in the principle of giving his wealth back to society, but he has very little faith in the government's ability to spend it effectively. He trusts the focused mission of a private foundation run by people he respects to do a much better job with his money than the vast bureaucracy of the U.S. Treasury.
So, takeaway number one for anyone who invests is pretty simple. You have to pay attention to tax policy. It's a huge driver of the economy. A good rule of thumb is that when taxes on investment are getting cut, that's generally a tailwind for the market. When you start hearing serious talk about tax hikes, that's a headwind. You've got to know which way the wind is blowing.
And the second takeaway is all about planning for your own future. You've got to remember that tax laws are not written in stone. They change all the time. So if you're building wealth, or especially if you're thinking about what you leave behind, you need good advice. And hey, Buffett himself has shown a pretty powerful path. Using charitable giving can be a win-win, allowing you to support causes you believe in, while also legally and effectively managing your tax situation. In the end, this whole story leaves us with a really big, fundamental question. If you take all the politics out of it, who do you think would do a better job spending billions of dollars for the good of society? A private foundation, handpicked by a genius at allocating capital, or the massive machinery of the U.S. government? It's a tough question, and your answer to it probably says a lot about how you see the world.
All right, welcome. Today we are diving into a really fascinating debate that sits right at the heart of investing. And the question is this: should companies tell us what they think they're going to earn in the future? Now, this is called earnings guidance, and for years, one of the most respected investors on the planet, Warren Buffett, has said no, absolutely not. But what happens when that kind of legendary wisdom runs headfirst into some cold, hard data? Well, that's exactly what we're going to explore. So we're actually going to start this story at the end with this really powerful conclusion from a major academic study. Think about that sentence. It's a direct challenge to a core belief held by some of the biggest names in finance. It just perfectly sets the stage for what is, a classic showdown, the philosophy of a legend versus what the numbers actually say. When Warren Buffett speaks, the entire investing world stops and listens. His track record is legendary. His advice is practically gospel for millions. And that's exactly why his long-running fight against earnings guidance is such a big deal. He's not just some critic on the sidelines. He has actively used his influence on the boards of giants like Coca-Cola and Gillette to get them to stop doing it. So you have to ask, why would an investor so famous for transparency be against companies sharing more information? Okay, before we go any further, let's just make sure we're all on the same page. When we talk about earnings guidance, what are we really talking about? Well, it's basically a voluntary forecast. This is the company's management team, the CEO, the CFO, getting on a call and giving their best professional guess about what the next quarter or the next year is going to look like financially. It's their inside view shared with all of us. And this right here is the absolute key difference you have to understand. Public companies in the U.S. have to file reports with the SEC. It's the law. The 10Q every quarter, the 10K every year. Now, you can think of that as looking in the rearview mirror. It's a super detailed report of where the company has been. Guidance, on the other hand, is totally voluntary. It's like looking through the windshield at the road ahead. And this choice to give investors that forward-looking view or not, that's what this whole debate is about. Now, let's be fair and really dig into the argument against giving guidance. This isn't some crazy idea. It comes from a really deep-seated philosophy from people like Buffett. They believe that a company's biggest advantage is its ability to think and invest for the long term, without getting caught up in the frantic day-to-day whims of the market. So the core argument goes like this. The moment you put a specific earnings number out there for the next 3 months, You create this dangerous, distracting game. All of a sudden, the goal isn't building the best possible business for the next 10 years. It's about hitting a number in the next 90 days. Critics say this forces executives to manage the earnings, basically to play a numbers game, instead of actually managing the real business for long-term sustainable success. And here is the perfect and, frankly, scary example of how that can go wrong. Imagine you're the CEO. It's the last week of the quarter, and it looks like you're going to miss your earnings target by a couple $1,000,000. But you know there's a $10 million R&D project on the books. What's the easy fix? You delay that project. Boom. Your expenses for the quarter just dropped, your profit goes up, and you meet the number. Wall Street's happy for about 24 hours, but you've just crippled the very innovation that could have powered your company for the next 5 years. That's the exact trade-off everyone is so worried about. So that case against guidance, it sounds pretty convincing, right? It feels right. But what if that whole argument is built on a slightly flawed premise? Now we're going to start to poke a few holes in it, because it turns out the problem might not be the guidance itself, but a misunderstanding of where the real pressure is coming from. And here's the big counterpunch. Whether a company offers a forecast or not, the SEC requires them to report their results every single quarter. That's not optional. And because of that one unchangeable fact, Wall Street analysts and investors are always going to come up with their own quarterly expectations. The market hates a vacuum, so getting rid of official guidance doesn't get rid of the quarterly pressure. It just takes the most informed person, the company itself, out of the room and leaves everyone else guessing in the dark. And this is where you can just flip the whole argument on its head. Instead of seeing guidance as this source of bad pressure, you can see it for what it actually is. Probably the single most valuable piece of forward-looking info an investor can get. I mean, who knows more about a company's future than the people running it day to day? Nobody. This isn't some random analyst's guess. This is info coming straight from the horse's mouth. So if we agree that people are going to be guessing no matter what happens when management just clams up? Well, analysts are left to fend for themselves, and their guesses are going to be all over the map, way less accurate. For you, the investor, this creates a thick fog of uncertainty. And in finance, uncertainty always equals risk. And more risk usually means a lower stock price. It's a chain reaction, and it all starts with a simple lack of information. All right, so we've talked about the philosophy, we've unpacked the logic from both sides. But you know, opinions and theories, no matter how smart they sound, don't really move markets. Facts do. So let's turn the page now. Let's get away from the arguments and look at what actually happens in the real world when companies take Buffett's advice. I mean, this is the multi-billion-dollar question, isn't it? It's the one that really matters to anyone who owns a stock. So a group of researchers at the University of Washington, they decided to find out for good. They studied almost 100 public companies that made this exact announcement. So, what did they find? The answer is absolutely stunning. The market's reaction is fast, it's brutal, and it is huge. For just a typical $10 billion company deciding to stop giving guidance, vaporized on average nearly $500 million of shareholder value. And that's in just 3 days. This isn't a rounding error. It's a loud, clear message from investors that taking away guidance is a major negative. And this little tale of two companies brings that data to life perfectly. So in January 2003, AT&T says it's ending guidance, and the stock gets absolutely crushed, down 19%. Just a month before, Coca-Cola makes the exact same announcement, and its stock barely moves, down just 2%. What was the massive difference? Well, Warren Buffett himself was on Coke's board. His incredible reputation acted like a shield, calming investors down. But this actually proves the point, right? If you don't have a living legend reassuring the market, investors are going to punish you for going dark. And believe it or not, the bad news doesn't even stop with that first big drop in the stock. The research uncovered a whole mess of negative consequences that follow. These companies tend to underperform their competitors for the entire next year. Just like we talked about, analysts' forecasts get way less accurate, which creates more volatility. Some analysts just give up and stop covering the company entirely. And maybe the biggest gut punch of all, there's zero evidence that these companies actually increase their long-term spending on stuff like R&D. The very reason they claimed for doing it, it just doesn't happen. Okay, we have gone through the arguments. We have looked at the powerful data. So what in the world does this all mean for you? How can you, as an investor, take all these findings and turn them into a practical strategy to actually protect and grow your money? Let's boil it all down into 3 simple, actionable steps. First, if a company you own suddenly announces they're stopping guidance, you need to be very, very wary. The data shows it is a massive red flag, and it often means management thinks trouble is coming. Second, learn to tell the difference between a rational sell-off and an irrational panic. If a great company misses earnings by a tiny bit and the stock gets hammered, that could be your opportunity to buy. And third, always bet on management's credibility. Just like the Coke example showed, a trusted leadership team you believe in is your absolute best defense against uncertainty.
And we'll end on that question. Look, Warren Buffett is an investing giant. His wisdom is timeless on so many topics. But on this one specific issue, earnings guidance, the evidence, the data, it all points overwhelmingly in the other direction. It tells us that more information, not less, is what really helps investors and makes markets stronger. It's just a fascinating reminder that in the world of investing, we should always respect the legends. But at the end of the day, we have to follow the data.
All right, let's talk about Warren Buffett. The name alone is legendary, right? He's pretty much considered the greatest investor of all time. But you have to wonder, beyond all the headlines, beyond the billions, what's his actual playbook? That's what we're going to do today. We're going to deconstruct the man, get past the myth, and find out what really makes him tick. Let's dive in.
You know, I think this quote just absolutely nails it. It perfectly captures why we're all so fascinated with him. It's not just about the money, not at all. It's this wild combination of pure, raw genius and this down-to-earth, homespun charm. It makes him this guy you'd want to talk to about finance for hours, and then you'd want to go grab a burger and a Coke with him. That personality is just as big a part of the legend as his portfolio.
So here's our game plan. We'll kick things off with the legend everyone thinks they know. Then we're going to poke some holes in this idea that he's a simple investor. After that, we'll dig into the 3 core ideas that have never changed for him. We'll see how he loves to break the rules that professors teach, and then we got to be honest about the parts of his playbook that you and I just can't copy. And finally, we'll wrap it all up with the real lessons, the stuff that goes way beyond just picking stocks.
When you think of Warren Buffett, the image is pretty clear, right? One of the richest guys on the planet, a financial titan. But like we just said, the reason people admire him so much, it's about more than just how much money he has. It's about the guy behind the billions.
Just look at this number, 2,897. That's how many books pop up when you search his name on Amazon. I mean, think about that for a second. That is a staggering amount. We are, as a society, completely obsessed with cracking the Buffett code. This isn't just mild interest. It's practically a global quest to figure this guy out, and that tells you everything you need to know about the power of his legend.
And that obsession leads us to, well, probably the single biggest mistake people make when they try to understand him. They try to slap a simple label on him. They try to put him in a neat little box. But as you're about to see, that's a fool's errand. It's just impossible.
Okay, so let's start with the most common label you hear, value investor. Find a solid company that's selling for cheap and buy it. Sounds simple enough, right? But that's not really the whole story, is it?
Because you can just as easily call him a growth investor. He's not just digging through the bargain bin, he's also looking for truly incredible companies that have a huge future ahead of them. So right away, that first label is already feeling a little too small.
All right, so what about the other classic label, buy and hold? I mean, that's his most famous saying. But here's the kicker. The guy also trades. He gets involved in currencies, commodities, even really complex derivatives. He buys entire businesses overseas. All of a sudden, that simple, neat little box is just completely overflowing. So this is the real secret. This is the big takeaway. His investment style isn't some fixed set of rules carved into a stone tablet. It's much more like molten lava. It's fluid, it's constantly adapting, it's always being refined. The true genius here is that his education never stopped. He gets that the world changes, and you're not going to win tomorrow's game by playing with yesterday's rules.
But, and this is a really, really important but, while his style is always adapting, his core philosophy is built on solid rock. Underneath all that molten lava, there are 3 bedrock principles that have been there from the very beginning.
And here they are, the big 3. First, his deep, deep love for the insurance business. Second, his almost obsessive focus on the quality of a company's leadership. And third, his absolute insistence on buying something for less than what it's truly worth, using a specific method called a discounted cash flow, or DCF. These are the pillars holding everything up.
Okay, let's talk about pillar number 1, insurance. The magic word you need to know is float. See, insurance companies collect all our premium payments today for accidents that might not happen for years. In the meantime, what do they do with that giant pile of cash? They invest it for their own profit. This float is basically a massive interest-free loan from policyholders, and it became the financial engine that built the entire Berkshire Hathaway empire.
Pillar 2 is all about people. You see, Buffett doesn't buy broken companies and try to fix them. No, he buys great companies that already have great managers, and he makes sure they stick around. He cares deeply about ethics, about putting shareholders first, and he has this genuine, visceral disgust for excessive executive greed, especially things like stock buybacks that just make management rich instead of benefiting the actual company.
And this brings us to Pillar 3, and it's a really crucial distinction. A lot of people mix up value stocks and undervalued stocks. A value stock might just look cheap based on some simple numbers. But an undervalued stock, in Buffett's world, is a company whose true calculated worth, its intrinsic value, is way higher than the price tag on the stock market. That discounted cash flow analysis he does, it's basically a way of projecting all the cash a business is ever going to generate, and then figuring out what that entire pile of future money is worth to him today.
So, with this core philosophy as his guide, Buffett has spent his entire career pretty much directly challenging what they teach you in business school. He's the guy in the real world who's constantly shaking his head at the theories coming out of the classroom. And you can see the clash right here. The academic theory is the efficient markets hypothesis. It basically says you can't consistently beat the market because everything you could possibly know is already reflected in the stock price. Well, Buffett's entire life's work is proof that he thinks that's total nonsense. He believes smart people who do their homework can and do beat the market. Then there's diversification. The professors say, spread your money out wide and thin to be safe. Buffett says, no, if you really know what you're doing, you should concentrate your money on your few best ideas. And his proof isn't just his own success. He loves to point to other investors, guys like Walter Schloss, who crushed the market for decades. To Buffett, these people aren't just lucky one-offs or statistical anomalies. No, they are walking, talking proof that the academic theory has some serious holes in it.
Okay, now we need to have a little reality check. As much as we can learn from his mindset, there are some big parts of Buffett's playbook that are completely off-limits to regular investors. It's important to understand that he's not just playing the same game as us with more money. He's on a totally different field.
I mean, just look at this toolkit. We buy shares of stock. Buffett buys entire companies. He becomes the biggest shareholder so he can call the shots. He takes seats on corporate boards. He's even stepped in and acted as CEO to save a company in crisis. These are power moves that we just don't have access to.
And here's another great example, Pipes. This is basically a special tool for the ultra-wealthy that lets Berkshire pump huge amounts of cash into a public company, but on special terms. They might get a better price or exclusive securities that you and I would never see offered on the open market. It's just another massive advantage that comes with being Warren Buffett.
So if we can't fully copy his moves, what's left? What's the real lesson from his incredible career? Well, it turns out the most important stuff has less to do with the mechanics of finance and a whole lot more to do with his way of thinking.
This right here is a masterclass in perhaps his greatest superpower, patience. He bought two companies, General Re and NetJets, back in 1998, and for years, they were a total mess. They didn't make any real money for 8 long years. Most of us would have given up and sold. But Buffett, he just stuck with it, he worked the problem, and eventually he turned those lemons into lemonade. That kind of long-term vision requires an almost superhuman level of conviction. So when you put all the pieces back together, you finally see the whole picture. The Buffett mindset isn't a simple recipe. It's this incredibly rare mix of being a student for life, having that iron will for patience, truly understanding what makes a business tick, and not being afraid to hold strong, often controversial opinions about how the world works.
And really, that's what it all comes down to, doesn't it? It leaves us with this final thought. When you truly deconstruct the legend, you start to realize that maybe, just maybe, his greatest gift isn't a hot stock tip. Maybe his greatest lesson is about a way of thinking, a framework for making decisions about business, about markets, and maybe even about life itself. It's not about the portfolio, it's about the philosophy.